Our next guest, Peter Schiff. Peter is Chief Economist, Global Strategist, Euro-Pacific Capital, a division of Alliance Global Partners. Peter, thanks for joining us again today on the show.
Oh, well, my pleasure to be here.
We'll try not to turn up the heat too much because I understand you're sitting right now in Puerto Rico with no air conditioning, so we'll try to make this quick. Bottom line, unemployment this past week went up to a level guesstimated to be 17%. It seems like a foregone conclusion it's going to be over 20. What do you think this means for the economy throughout the rest of 2020 as well as the stock market?
Well, both the stock market and the economy are in a lot of trouble, probably the economy even more so than the stock market, because what the Federal Reserve is doing may artificially prop up the stock market, but they're not going to have as much success with the real economy. In fact, the reason that the economy is so sick is not because of the coronavirus. I mean, that's probably making it worse, no question about that. But even before the coronavirus came on the scene, the economy was ill. And that's because of what the Fed did in the decade leading up to this disaster. So what we're really going to be suffering from is the hangover from all of the stimulus of the past, all the 0% interest rates and quantitative easing. And what the Fed is doing now in the aftermath of this crisis is only going to compound the problems that it created before the crisis.
So, Jeff, I know you've got some strong feelings and thoughts on the Fed and everything else, so go ahead.
Well, Peter, the last time you were on the show, you and I chatted about something. I'm going to shift gears for a minute. We talked about all this endless money printing, and this has got to be your worst nightmare because now the Fed has an open checkbook to cure all the ills here and be the buyer and lender of last resort. But, you know, you were really hyper-focused on inflation, and I don't see inflation ever occurring from money printing, especially with the deflation that we're experiencing. And one of your picks was gold miners on the show the last time, and gold miners have been obliterated. Even though gold is up 15 to 17%, most gold miners dropped 200% plus in this correction that we have. So how can we have inflation going forward when there's no inflation? The Fed's been trying to create inflation for the last 10 years.
Well, first of all, most of the major gold stocks have hit new multi-year highs this week, so I'm really not sure what you're talking about. Yeah, there are some junior miners that have been weak, but overall, gold stocks are doing a lot better than the overall stock market year to date. Now, they should be doing even better given what's already happened to gold and what's likely to happen to gold. And I think that's going to happen. So I think people should be buying these gold stocks as quickly as they can. But as far as inflation is concerned, inflation by definition is money printing. That's what's being inflated is the money supply. So we've never seen the central bank create this much inflation in its history. To think that it's not going to affect consumer prices, I think, is completely ridiculous. I mean, it already is. Prices are rising for the things that people are really buying, like food.
Yeah, but Peter, money printing only causes inflation if it increases demand. Now we've got excessive money printing with no demand in this new corona economy. I think some of your viewpoints, Peter, are divorced from economic reality on some of this stuff because the way you frame them make them sound like that.
It's your opinions that are divorced from reality. Mine are grounded in reality. When you create money, you are creating inflation. Now, that inflation will manifest in various ways. I mean, when the stock market went up a lot, when the real estate market went up a lot, it was inflation that was driving those price increases, not the real increase in the value of the businesses, but the nominal price. And prices are going to rise. The Fed is putting money into the economy at a time where production is actually going down. What's happening as a result of the coronavirus is businesses are not operating. Goods are not being produced. Services are not being provided. Yet we are creating more demand by flooding the economy with freshly printed money. You're just focusing on certain prices. Yes, airline tickets are down. Nobody is flying. Okay, gas prices are down. Nobody is driving. This is only temporary. But look at what's happening to other prices. They're already rising, and they're going to rise even faster in the days, weeks, and months ahead.
So Peter, in the spirit of the terrible incident from the 90s, in Rodney King's famous words, can't we all just get along? We have 1 minute left in the segment, so let me ask you the question this way. I understand what you're saying, but I also see that production is going to get ramped up. In fact, if the president has his way, it's going to ramp up sooner than later. So in the last minute and a half we have, do you think it's possible that the inflation once again shows up in an asset bubble and it benefits the wealthy as opposed to the average person out there?
Well, inflation benefits debtors, when people who have borrowed money, particularly to buy productive assets, and it hurts wage earners, savers, people who have credit. Right. So that's going to happen. But remember, all of the stimulus, all of the bailouts have to be funded. They have to be paid by something. And if the government is not going to pay for it with taxes, they're doing it through inflation. The government is funding the stimulus and the bailout by stealing the purchasing power of savers and spending it into the economy. But again, there is no free lunch.
But Peter, just real quick, in the 30 seconds left, why do you think it can't happen as asset inflation as we've seen really since 2008? Because that just seems more likely to me.
That bubble is popped. We're not going to fund trillions and trillions of dollars of government spending simply by propping up the stock market. The public is going to have to pay the price of these bailouts, and it's going to come from the reduced value of their wages, the reduced value of their savings. The cost of living is going way up. The government is not taking people's money, but the government is taking the purchasing power from people's money, and they're going to feel that every time they try to buy something.
So, Peter, we need to leave it there for now, unfortunately, to go to commercial break. So, bottom line, you still think there's going to be price inflation here in the United States, and who knows what the future holds. You could be right. Thanks for joining us again today, Peter. Thank you so much. You stay with us, too. We'll be right back here with more coming up on the Income Generation. We'll be right back.